Welcome to the Retirement Lifestyle Show. I'm your co-host, Roshan Loungani, here as usual with my colleagues, Erik Olson and Adrian Nicholson. We're excited to have another episode of the Retirement Lifestyle Show for you. So, Adrian, what have you been seeing this week?
Hey Roshan, hey Eric, I'm doing good. I've just been thinking a lot this week about brand and rebranding, and one of the things that's been keeping me up at night is next time we're all in a room together, we got to take a really fresh picture together and update our podcast logo because I was kind of a little bit motivated because our firm Arate came out with a new logo that I think is really cool, looks very symmetrical, very trendy. And I like anything with an A in it, and the Arte logo has an A in it. If you look around my apartment, I have things with A's on it everywhere. Like I have this coaster right here; it's got an A on it. A friend recently got us an apartment housewarming gift, and it's this cheese board here. It's got an A on it as well. So it's just been running through my mind about just maybe like rebranding and all that stuff. So that's been something I've been tackling with this week. And I think next time we're all in a room together, we have to get like a nice picture to kind of rebrand our podcast image.
I like the idea. I mean, with what's been going on with the pandemic and how we record on Zoom, I almost wonder if it should just be a Zoom screenshot. Should be the new.
I was thinking about that too. That was like one of the first thing that came up. And you have one of those cool backgrounds, so you'll have an advantage on us for sure.
Yeah. Yeah, it hides the bed when it's not made, right? The background.
Exactly. But yeah, I'm excited again for another podcast today. We're going to touch on market outlook and a number of other topics. Eric, do you want to kind of lead us into this?
Yes, Adrian, I would like to do that.
Hold on. With the A's, why do I want to buy you an Alvin shirt from Alvin and the Chipmunks and see you wearing that?
I just like anything with an A on it. Honestly, it's kind of like my go-to thing. So it's pretty cool.
Well,
when I was younger, I used to buy all Ralph Lauren stuff because of it. I have the same initials, RL. So it's the same way. I still, when I work out, I still have this old sweatshirt with a huge RL on it. And it keeps you warm, but I do wonder why I like that so much when I first got it.
It does. It helps build a small little connection for sure. Yep.
It does. Fantastic. I'm sorry, Eric. Let's get back on topic today.
Well, before we get entirely on topic, if we're talking about initials, here's my two favorite ones right now. SD. The Padres have been the moves that we last talked about sports, acquiring Yu Darvish and Blake Snell, as well as this top player Kim from South Korea. I'll tell you what, I am so excited for the baseball season.
Eric, do you plan on going to any games if they open up like the stadiums in the future? Is that going to be the first thing you go to?
Oh man, I'm going to be there. Yes. In fact, I was talking with one of my clients yesterday about it, who's a huge Cubs fan, and said, okay, look, if the Padres come to Cubs, to Wrigley Field and it's open to fans, I'll take you. And she said, nice. Deal. So that's
How'd
great.
You become a Padres fan? Being in
Chicago?
My
dad was in the Navy, and so kind of wherever we were when I started getting really interested in the sport, I just attached to that, and the loyalty element in me is pretty strong. So it just never could let go. So I'm a schizophrenic when it comes to all that. I'm a Vikings fan, Lakers fan, Red Wings fan, and most of all a Padres fan. So it makes no sense, but it is what it is.
Anyway. Well, 2 out of 3 or 2 out of 4 make your life easy as a sports fan, right? Thinking of the Lakers and the Red Wings.
That's true.
Whereas
that's true.
The other 2 give you heart attacks.
Suffering. It's been a lifetime of suffering. More Super Bowls lost by the Vikings than any other team, I think. Anyway, why are we talking about markets? Why are we talking about the 2021 outlook for markets and the economy? Well, this obviously we've come out of a pretty incredible year, 2020, at many, many levels, certainly societally, politically, from a human health standpoint, but also economically. So after having been going gangbusters and reaching just historically low rates of unemployment in some parts of our economy, we then suddenly see a drop in GDP in the second quarter of 2020 that rivals anything that was in the Great Depression. And yet in the aftermath of that, we've seen this incredible rebound, at least in the markets, and also to a large but not complete extent in the economy. So it's, I think, useful from time to time, and the turning of the page on the annual calendar is, I suppose, as good a time as any to step back and try to reassess how all of these things fit together and what the implications are for us globally, as well as here in the United States from an economic standpoint, and then more specifically what's taking place in the markets. And when I say the markets, I mean not just the U.S. stock market, or let alone the U.S. large cap stock market, but markets. So that would be both outside the U.S., within the U.S., different sectors, different size companies, different valuations, and so forth, as well as fixed income and commodities. So there's a lot of territory to cover, and we don't pretend to be able to do so exhaustively in the time that we have here this morning. But I thought it would be useful for us to at least make sure that we covered some of the waterfront. And then clients and listeners, if you have questions about these things, we just would say, yeah, engage with us in our next meeting. Or if you're a listener but not a client, reach out to us if you have questions. We'd be delighted to have a follow-up conversation with you.
Yeah, and I'm going to give a more basic answer as to why I think this is important as to everyone listening. In the immortal words of Rod Tidwell, show me the money, right? Everyone's, Adrian, are you old enough to know who Rod Tidwell is?
I know the quote, show me the money. That's okay. A popular one, but that's an important thing, especially kind of looking at the market outlook going forward, just seeing where the money is, following it, looking at balance sheets. Just another big thing is whether this year is going to be kind of a broad move in the market, or is it going to be concentrated in certain areas? It's going to be more narrow versus broad. I think that's a important area to really look in, and obviously the economic backdrop is really important for that with the markets.
Yeah, I think it's a great place. It's people have their, I mean, we're the retirement lifestyle show, right? People have their wealth and their retirement tied into the different markets, and let's give them our thoughts on the matter. So I know we wanted to start with looking at the economy first and looking at the stock markets. We'll then get into a little bit about housing, and then a fun topic as well as a little bit about in the crypto space. So Erik, why don't you start us off with what are your thoughts from an economic / market, publicly traded stock market perspective?
Okay, I'm going to start with the economy. So if we were having this conversation in late 2019, we would be looking at a variety of projections for economic growth, both domestically and globally. And at that time, spirits were, modestly optimistic about where things were going. We were seeing some stronger growth rates in both real terms and in inflation, nominal and real inflation adjusted terms, both globally and domestically. And people were riding high, and so they would project out 2, 3, 4, 5 years as to where the global economy would be and where the national economy would be. Then, as I said in my intro, we hit this worldwide pandemic, and in response to that, governmentally enforced lockdowns, and also public response that is, slamming certain industries harder than others, but certainly retail, hospitality, restaurants, and energy, just got completely slammed. Airlines slammed. So at this point, the question is our trend line from here? So we are below that trend line, even though we've had some of an economic recovery. Is our trend line more like a spatula, or is it more like, I guess a rain gutter or something like that? I don't know what maybe a good analogy is. Did we reset to a kind of we're going to resume the old growth rate, but starting from a lower level? That's the spatula idea. Or are we going to actually at some point have as much growth as we lost, so that 3 years out, we're in precisely the same place from the size of the global economy that we would have been had we not had this massive downturn in 2020. And we see a variety of views. And so most acknowledge that there are optimistic scenarios, pessimistic scenarios, and maybe base case scenarios. Most of, but not all of, the base case scenarios that I've seen do have us probably in 2024, by 2024, if not earlier, actually back to the same point of global, what we call global economics, global, it's not really global GDP, but if you can use that analogy, the size of economic activity worldwide, we might be back to that same point. If that's the case, and I'm not saying that it is, but if that is the case, then that implies really strong growth rates now.
I've got to interrupt you, right? Last year, markets got crushed, coronavirus, the global pandemic, everything shuts down, markets drop 30%, then the markets recover, right? And so in the long run, the connection is the economy drives the markets. And if you're investing in the markets, that's where you can grow your wealth. Why do I care about that now, right? And what I mean by that is it seems like the markets recovered before things opened back up, and based on, and you can feel free to disagree, but based on economic, based on fiscal and monetary policy, based on stimulus, the markets are up. So if I'm looking at an indicator, why not throw out economics and do a gauge of here's what I think the government's going to do with stimulus, and then have that guide where I invest my money. I think you can make an argument that might be a good move going all the way back to 2008, 2009.
Well, I'm absolutely not denying the role that stimulus and monetary policy play in what's taking place in the market. I was just thinking that, at least from my outlook, is to first establish a foundation of understanding or expectations about the economy, and then I would apply an overlay of those fiscal and monetary policies, and then on that I would also talk about the baked in response already evident in market responses, since in my view markets tend to anticipate what will be rather than necessarily reflect what currently is. So I'm not disagreeing. I'm just it's just a slightly different focus.
Yeah, and I guess my challenge was just stated differently is traditionally what you're describing is the way to go, right? But with this low interest rate policy and with all this stimulus, is the traditional method one that doesn't apply at the moment?
Well, I suppose, if our only concern was markets, then perhaps. I would say, though, I do think, we see people who are out of work or businesses that are suffering. And I think particularly the people that have been hardest hit by all of this are not, more or less white collar people who have jobs that, like ours, are, more, I would say, keyboards and emails and Zoom meetings. Instead, it's physical contact and with actual people. So from that standpoint, I would say to see, I think every one of us longs for that segment of all societies, world societies, the U.S. society, to share in the benefits of a recovery. So, but yeah, if you want to talk more narrowly about markets, I certainly agree that fiscal and monetary policy is huge, and interest rate policy as well is hugely influential.
Yeah, those are some great points you brought up, Eric. And markets are always trying to price ahead. And I believe we spoke about it in a previous podcast, how they're kind of like voting machines, and just trying to price in ahead is the biggest thing. Depending on what the economy is doing is always a factor to consider. And another element of this was just how volatility was last year, the VIX just going to these new levels because there was a lot of uncertainty in the marketplace. And that's something to look at going forward. Is there a little bit more certainty than there was last year? Maybe a little bit, but that's just another element going forward. Are we going to still have these big swings in the market, or is it going to be a little bit more stable because there's a lot more monetary and fiscal spending? Companies are trying to build up their balance sheets, having more cash on hands are all big things to look at right now when you're looking at the overall market.
Mm-hmm.
Yeah, and don't get me wrong. I'm not saying don't look at the economy. I just also think at the level you describe with the individual, right?
Mm-hmm.
That's dealing with how tough things are. Small businesses, and like the workers that are having that contact. Looking at the economy, I guess it does give you. It's an overall view, but I mean, if I'm unemployed or my business is shut down and the economic data looks like it's going up, that doesn't help me at all. I'm still shut down my business. Do you know what I mean? I get your point. I see where you're going from it. I'm not trying to throw it out the window. I just feel like it's sometimes the data set gets so big that you lose the individual.
I see them as directly connected, but maybe not, because I do recognize it sector by sector. But anyway, let's talk about let's shift away then from talking about economies and talk about markets. So we have many markets that we could talk about because there are many potential categories in which people could invest. So I have some ideas about where some opportunities currently exist, and but I imagine you do too. What are some what you think are noteworthy changes that are occurring, or that you think opportunities that are presenting themselves in the markets? And by the way, we just want to, again, when we have this conversation with you listeners, want to emphasize that this is not meant as generic sort of sweeping advice for people, but rather this is just trying to make sense of and recognizing that market tone does change from sector to sector, from large to small, from value and growth, from domestic to international, that currency valuations change and so forth. And we're just trying to sort of develop a sense of watching some of the changes that are occurring, or recognizing which parts of economies tend to respond or which ones have still been lagging. Where does that possibly provide us some insight and direction as to how to think about portfolio tilts, if at all?
Yep. Yeah. And I'll tell you the biggest theme that stands out to me, and this is looking at the overall markets. And Eric, thanks for that disclosure. As you said, this isn't advice. But the biggest theme to me last year was that tech and large cap growth drove the markets, right? If you weren't in tech or large cap growth, you underperformed in 2020. And I think we've started, it looks like to me already, and I think it'll continue. We've all started to see a rotation to some of the other areas. And if you just think about that, this is where I think I'll look at the economics and what's going on at a bigger picture. But if the vaccine is available, and the world gets back to normal, it would make sense that we'll get more of a broad-based recovery because things are getting back to normal versus one focused on tech. And if all that money that flowed to tech then gets spread out across a broad-based economy, and when I say money flowing, I'm not just speaking about purchasing software or new computers, things like that. I guess new computers isn't exactly right, but I'm not just talking about purchasing those technological items. I'm also talking about investment dollars going to that space. So I think you're going to slowly see a rotation, and I say see, but I think it's already begun, a rotation out of tech and into more of the broad-based economy.
Well, first of all, I agree with that very much. Typically, and that's not uniformly true, but it's typical that coming out of a recession, even an abrupt one like we had with the COVID and shutdown related recession of the second quarter, especially, Usually what leads out of those are value stocks, and oftentimes small value stocks. And that indeed is precisely what we've seen in the markets. If we broke it down by style, when I say style, I mean size, and large, medium, small size companies, and then growth or blended or value companies. It's been, relatively speaking, the strongest surging segment of that grid has been small cap value, and followed by mid cap value. So, and which was, as you pointed out earlier, Roshan, not the case coming into that. It was large, and it was growth that was by far the dominant play.
Yeah, and it's and you had said you're already starting to see that as well. Just confirming, we're seeing the same thing, so to speak.
Yeah, if I look at the S&P 500 in ETF SPY, SPY as an example. Again, folks, we're not recommending anything. This is just commenting about what has happened. And that is from the bottoming of the market, it's close, the S&P 500's close on March 23rd to, I think I was having this conversation with a client yesterday. If I recall correctly, it was roughly a 70% rise off that low. That's a powerful rise.
Yes.
But small cap value, as represented in one ETF, I'm not going to name the ETF, it's one of the small cap value ETFs that I track, was up 105% off that bottom. So essentially another 70 versus 105, you're talking about an extra 35 or an extra, it moved up 1.5 times as much off the bottom as large cap blend in the S&P 500 did. So, and not far behind that was large cap value, also exceeding the climb off that low from March 23rd. So that to me is really interesting. As well as, I'll mention, if we want to open this up a little bit and talk about international. So it's been, if you look back over, let's say, since the bottoming of the market in March, not of March of 2000, but instead March of 2009, 11 years earlier, when the great financial crisis finally hit the bottom, which I think was March 9th or something like that, if I recall correctly, of 2009. If coming off of that low, if you look at all these sort of different potential, the usual building blocks that we would use in a well-diversified portfolio, what are the things that have been really close to flat? I mean, well, zigzaggy, but ultimately no real progress. Emerging markets. Yes. And to a lesser extent, but also not terribly heroic, large and small cap companies in developed countries outside the United States. Unimpressive. But now, coming off that March 23rd, 2020 low, what you're seeing is those plays are as strong as the large cap US market. So I think that is really interesting. And I have an idea or two about why that is, but let me pause there and see, what your thoughts are, or counterreactions against that are.
It is very interesting, and it shows the importance of looking at where you are positioned this year. I think that's extremely important. Like Roshan said last year, it was kind of some narrow areas really did experience some strong growth from their bottoms, and key technical levels and resistance levels were broke, but some of them didn't have that same amount of recovery and kind of maybe moved in a straight across line or in a zigzag line and didn't really experience that growth. So kind of reevaluating certain markets in certain areas to make sure you're very diversified and can experience some of those ups is extremely important, because it's a new year. Again, new innovations are being made with a vaccine that could potentially help certain areas that were beaten down pretty hard and couldn't really experience the same growth that some other areas of the markets could really benefit from.
So, Erik, you had said you have, well, I'm definitely seeing the same things you are, but I'm curious. You had said you had some thoughts as to why you think emerging markets are starting to break out. What are you seeing? What are you thinking?
Well, one is just at a longer term level, I believe that broadly speaking, valuations of those companies are much lower than they are in, and I'm not saying that's true for every emerging market or every company, but taken as a whole, the companies in various emerging markets around the world, I think have lower valuations. When I say lower valuations, people are, maybe some listeners are saying, what does that mean? It doesn't mean that their dollar price per share is lower. That's not it, and that's irrelevant. What it means is how much does a dollar of when you invest a dollar in something, how much profit behind, are you buying in effect? How much profit are you buying? How many sales are you buying? How much, what we call book value, are you buying? All different, how much free cash flow are you buying for every dollar that you spend to invest in one of these companies? Well, a attractively valued company is going to have a, gobs and gobs. That's a technical term, Adrian. That's it's gobs and gobs of free cash flow or sales or what have you, a profit for every dollar that it costs to buy that company. So that's one, is valuations. The second is currency shifts right now. So the dollar had really reached was surging against a basket of world currencies for quite some time. But in March of this year, that shifted. And since that time, the US dollar against that basket of global securities is down, depending, on the date you measure, somewhere between, let's say, 11 and 13%, something like that. So what that does is, when you invest in an emerging market using US dollars, the returns that come back to you denominated in US dollars, if that position is not currency hedged, a falling dollar effectively rewards your investments outside the US, in emerging markets or in developed markets outside the US. So it's currency moves as well. And then finally, the last thing I'd say is that not all, but many emerging markets are, of course, there's some commodity base to them, a stronger kind of commodity element to them. And as global economic recovery occurs, that means there's more demand for those commodities, and as a result, that helps commodity-based economies. Fortunately, you've seen over the last couple of decades this growing middle class. In fact, the middle class is growing so much faster in emerging markets than it is in the developed markets. And as a result, you're seeing more and more, as they have more and more discretionary dollars, then they're applying that to, more and more sorts of goods and services that, we would consider to be sort of wants, not needs. And that also is driving the success of companies that are responding to that surging middle class growth in those places.
Well, Erik, you mentioned earlier how this has really been the case. What you're, in terms of valuation, right? Getting better deals theoretically in terms of investments being priced better valuations since really 2009. And the story of the emerging middle class, I feel like I've definitely been hearing that for longer than before 2009. Right, that's a continuing theme. But as an investor, I would not have done as well if I had put my money in that in 2009. So what's different now than the last 12 years in the emerging market space?
So I think it's two things. And one is that in this case, the impact on the global economy simultaneously because of COVID and the shutdowns has slammed the brakes on GDP, or GDP, gross domestic product growth in a lot of these economies in a way that hasn't been seen in quite the same way globally for a long time. And so just even a reversion to normal in a lot of those economies with large populations is that's significant amounts of economic activity. If you're India and you have, I think the size of Indian population, if I'm not mistaken, is about 1.3 billion now. Do either of you know the precise number? Somewhere in that range. And China, I believe, is at 1.2 or 1.3 billion as well. So that's a factor. The second factor, though, I also think is now this shift in currency valuations, relative currency valuations.
So once again, going back to the time frame, population's always been that big, right? Like I'm trying to understand, because this is something I have personally invested in and been wrong about in the past, right? So I'm not questioning your data. I'm questioning. I can't remember the exact quote, but I remember seeing a quote that said something like, "In investing, having the wrong timing just still means you're wrong." Right?
That's true.
Something to that effect.
That's true.
So the population isn't different, and or than it was. It's grown, right? But population was huge this whole time, and we haven't seen it move. So going back to your currency thought, though, what are you thinking there with the currency, with the inflation they have? The currency, at least if we're looking at exchange rate to dollars, that's just been continuing to devalue for so long.
You're talking about the currencies of emerging markets.
General emerging markets, yes.
So, well, I agree with you. Although, as I mentioned, from March of this year, the dollar, it's increasingly strong posture globally has now turned and is going the other direction. So if you had nothing else but a currency headwind of, let's say, somewhere in the order of 10 to 15% per year, if that continued for a while, I'm not saying it will, but if that did, that alone would serve to make a investment where the origins are in a non-dollar context and then expressed back into a dollar context, as is typically the case with the investment vehicles that we use for this purpose, namely, let's say, mutual funds, exchange traded funds, or what are known as American Depository Receipts, ADRs, the stocks, in other words, that are on the stock exchanges of the United States. Then in this case, that currency shift alone, if there are none of those other factors that I mentioned, is, it's a lot to move the needle right there. And in fact, you're seeing that thesis validated, Roshan, by virtue of the fact that, again, coming back to the point I made earlier, if you look from March 23rd until now, while you're not seeing the same surge as small cap value and large cap value, and mid cap value, I mean to say, if you look at emerging markets and how they've been recovering off of that bottom, they're the equal of the large U.S. stocks when expressed in dollar terms.
Well, so I hear what you're saying, but if it's a currency play, why not go to gold, or we're going to talk about this later, even crypto assets, right? Is emerging markets the right way to go after this thesis if it is currency driven?
Oh, maybe I've misunderstood the context of your question. So I'm not saying, hey, everybody, sell your U.S. positions and dive all into emerging markets. But I would say that, I don't know, do you have clients like this? I have a number of clients who it's all U.S. all the time.
Okay.
And it's all growth. It's all large growth U.S. all the time. And that's the only thing they want to talk about, the only thing they're interested in. And the questions go along these lines. Why would we invest anything in, outside the US? Why would we invest anything in these emerging markets? That's not the hot dot. And I would say, because we never know when the shift is going to come. That's part of it. So if I were just using sort of a sort of typical representation here, Roshan, let's say I have a client who's an aggressive investor. And again, folks, what I'm about to say is not a prescription. It's just a report. of what what we do. So if I have a client who's an aggressive investor, meaning I would say probably 95% of that portfolio is allocated to equities, then in that case, probably 11% of that portfolio, somewhere in that neighborhood, 10 to 12% of that portfolio, in my view, ought to be allocated to emerging markets. Notice I didn't say 75% or 50% or even 20%. I said 11%. But for some clients who think about, well, this is how they want to invest, that emerging markets, or let alone international developed countries, are not even on the radar, which I think is a mistake. I have a friend who's in the UK, and he asked me to take a look at his portfolio. And it was really interesting because almost everything was UK based. And some of it that wasn't was based in Europe, but there was about 4% of his portfolio that was allocated to the US. And so I think you have inherent in people, there is kind of a home team bias. Here in the United States, that's been particularly reinforced by the fact that as you pointed out earlier, large cap growth has been killing it compared to a lot of the other asset classes. So
yeah,
my
I'm
point
following you, Eric. Yeah, and you bring up a great point where if you are an aggressive investor and you kind of have this like home team, so to speak, portfolio, then you're not really diversified, so to speak. Trying to diversify within the asset class you're in is extremely important when you're considering just looking at your portfolio moving forward, where you're not totally diversified because you are in a specific equity group and asset class group, but you're trying to diversify within that to give yourself some exposure to the broad range of the markets and the global markets.
Yeah, and Eric, just to be clear, I'm trying to just get sort of deeper in the idea, but when you break it down to things like portfolio allocation and diversification, I don't think there's a good argument against that, right? I guess there are, depending on the investor, right? Because as you mentioned, you're talking to people who only want to be in certain areas sometimes, and I see that as well. It's more of and emerging markets, as you said, they have recovered well. The index at last year was up 14.2%, with the S&P up 15.2. So very similar performance in 2021, and maybe this will be the opportunity of the year for that. But continuing on, let me ask you what other thoughts, ideas, or themes you're seeing for 2021.
Yeah, I have another one. I think is
Yes.
more of a trend that you could see moving forward would be companies that you look for companies that have strong balance sheets, good numbers, and are just overall sound companies. Maybe strong dividends is a really important thing. But as you're seeing new investors move into the market, and as the years go by, you could see more of a focus on ESG impact investing, where companies aren't solely focused on the bottom line, but also how they impact the environment, how they give back to the community. You're starting to see a little bit of a shift in investors' mindsets when they kind of look at certain companies or evaluating the certain growth aspects are extremely interesting areas to kind of look at when you're kind of building your portfolio or looking within certain sectors or industries as well. And also another element on that is a new administration change too, where you could see certain dollars being allocated to certain areas of the economy and the market to promote some of these things. So it's another layer to kind of think about when you're looking at the overall market and the economy moving forward in 2021.
Yeah, and Adrian, when you talk about that, that's something where maybe this is a topic of discussion later, not today, because we're going over our overall outlook. But that clean tech area, we've discussed it previously, but with the Democrats taking control of government, that's a place that is likely to be, and I say likely to be a winner, but it has been sort of an early winner so far already in that space, in the investing world, just looking at that theme. So
yeah,
ahead,
absolutely. There, well, I track a number of stocks in a variety of these areas, and one, I'm not going to mention the stock, but I'm going to mention the sector. It's a stock that focuses on producing biodiesel.
Yeah.
And oh my goodness, as it got clearer and clearer that this would be a blue wave or something like it. And that one term I'm seeing now thrown around, which it was a light blue wave, because the margin of the Democrats' majority in the House reduced, and it's, you need the vice president elect Kamala Harris when she's in office to break a tie to get a 51-50 outcome. So it's a light blue wave, but nonetheless, these biodiesels and these alternative energies and green energy companies have really been some of them thriving in with expectations for a favorable policy environment for them.
Yes, yeah, that is definitely one of those spaces that I think that theme I think will continue into 2021.
Mm-hmm.
Do you have any other, or I'll throw out another thing that I think is standing out. I mentioned earlier how I think we're starting to see a rotation from tech into more of a overall
Mm-hmm.
recovery.
Mm-hmm.
But I think consumer discretionary is something that I think should do well this year, just because people didn't have the opportunity to spend those dollars last year. Right. So I think you've got some like in that space, or in that category, things like just travel, vacations. People weren't able to take vacations. So even some people might take a bigger one because they missed it last year, or some people might just take the same one, or some people might take a smaller one, last year being tough economically. So whatever the case is, I think dollars will be spent. And that will lead to stock valuations, or prices, going up.
I certainly think that's true in some subset, or a subset of the consumer discretionary category. And you mentioned leisure and travel. I think that is absolutely the case. I was looking at a graph showing the normal airline volumes, passenger volumes, and miles flown in 2019, and then comparing those on a month-by-month basis with an overlay of what was taking place in 2020. And by the end of 2020, even though there'd been some recovery from March, the volumes were still only about a third of what they were at that time a year before. So I would say there's plenty of potential, I would think, in that category, as well as in hotels and resorts, and to potentially restaurants. This is a bit of a sidetrack, but I do think there was probably an oversupply and a shakeout that would have come to the restaurant sector whether or not we'd had lockdowns. But nonetheless, I think with the impact that this has had on the restaurant industry and reducing the number of active restaurants, I'm sad about it. But just looking at it from that vantage point, I think, well, once you have people saying, I need to get back to a dinner out with my friends, and are doing that, with all due respect to our friends in Texas and Florida who are saying, what are you talking about? We're still doing that. Believe me that the rest of us in Illinois and Michigan and in DC are longing for the day when we can do that again. But when that happens, I think you'll see those that dollars are going to flow there, I would think, in a big way.
Yeah, I agree. And I'm going to ask both of you, I want to move us on to the other two. We'll spend a little less time on them, but any other 2021 market outlook, thoughts, ideas, areas that you're seeing, just to touch on us, more of a final thought. Yes, I am trying to rush you a little bit.
That's okay. I have a couple. Adrian, how about you?
I'm all set. I'm probably going to hear that from Erik, that pun for the rest of the
forever.
podcast.
That's gonna be a regular feature.
I'm ready for it. It's all good, but I'm all set. What do you have, Erik?
Well, I just think we'd be remiss if we didn't mention interest rates and inflation expectations.
Yes.
So what's your outlook on inflation? Because a lot of our clients and a lot of our listeners are thinking about income, and for many people, historically the source of that has been fixed income instruments, bonds we're talking about in particular, even CDs. Remember CDs? Do you remember those things that you would actually get paid on some cash? So what are your expectations for interest rates and inflation?
Well, I don't. I have not seen anything at all indicating that the Fed will do anything to increase rates. Although when we get into the housing piece, I am seeing that there is an expectation of a slight increase in mortgage rates. So, but I think that's going to be market movements as opposed to the government, any kind of government action in that space. For the interest rate side, on the inflation side, I don't necessarily see a cause for concern yet. Everything I've looked at still says we're something in the twos. So nothing. Um, Typically, with all this money pumping in the economy, that's a fear. But I everything I'm reading and seeing is saying we hope we can get some inflation going. Either of you have any thoughts or ideas?
Yeah, I'm seeing the similar thing where rates are going to be maintaining at this level, where the Fed just kind of take a wait and see approach and kind of wait on the sidelines, and inflation as well, where that's also a big determining factor on how the labor market is, and the labor market's obviously going to take some time compared to how the actual market's doing, and that's kind of thing that you have to just be constantly updated on throughout the year.
Yes, I agree with both. So much of it is contingent on Fed policy, and
Yeah.
so that's where the jury's still out. But it does seem like they're very committed to, I would say, perpetual intervention. Whereas once upon a time, it was sort of it was episodic when there was a real need for it. It seems as though since the financial crisis, there's a relentless commitment on their part to constantly try to guide rates and through that interest rate policy promote well, I would say whether or not it's intended to this purpose, the net effect of it is that it promotes asset growth in risk assets. And so that's another consideration too. Maybe we should also talk just about valuations. Do you have an interest in that, or do you want to save that for another time?
I would actually throw that over to you, because I feel like valuations have been somewhat out the window for so long, right? That I don't see that changing. I mean, you can look at it in certain areas and sectors, but if you're looking at overall market valuations, they've been high for, at this point, 8 years.
Right. Yes.
Right.
It's been like that. So here's what I found an interesting result was recently. We've mentioned, I believe, in the past on our podcast, the name Robert Shiller, who is an economist at Yale University and the author of Irrational Exuberance and so forth. I believe it's a Nobel Prize winner in economics, and so he's well regarded. And he has this thing called the Shiller cyclically adjusted price to earnings ratio, which we've cited from time to time. Well, he made a very important revision to that tool I believe it was in November. But what he did is he said, you know what, it's probably worth looking at the question of taking the interest rate environment into account. And I won't bore you with the specific details of how he works that through the formula, but the net result is that when you sort of, if you alter this formula and you take the interest rate component, real interest rate component into account and adjust the earnings accordingly, suddenly it makes the markets look actually not outrageously overpriced, at least the equity markets. It makes the equity markets in that light look as though they're close to, maybe a little above, but close to sort of normal valuations, which really surprised me. And so it's prompting a rethinking in my own mind about how to think about valuations at least using those long form, multi-year perspectives. So why I raise that is that if indeed equity markets are in an adjusted way like that, closer to normal, then I would say our forward expectations for, let's say, the next 5 to 10 years, we might be justified in having somewhat more optimistic expectations about where those markets wind up. Because if you used right now, let's say, I think we've talked about this before, the Buffett indicator, or if you looked at the Research Affiliates has a really interesting model as well that we can discuss in greater depth sometime. But in all of those cases, if you were to sort of extend out 8 or 10 years, what you would expect for equity returns, they're pretty much in the neighborhood of 0 or minus.
Yes.
On a compounding basis. But if Shiller's adjustment to this model is justifiable, and it actually reflects some reality in this way, I'm encouraged, because then it says to me, I can talk with my clients about not having their expectations for equity returns quite as subdued as these other indicators were sort of directing us to think, the terms in which they were pointing us to think. I think it will perhaps have a more optimistic outlook.
Yeah, and Eric, I believe that's called the excess cyclically adjusted PE ratio. I
Oh, is
believe
that
that's
it?
the
Okay.
term Schiller is using, and that's interesting that it came out now, because I know for years people have been saying, that his ratio, which worked really well 20 years ago or made a lot of sense then, didn't quite apply now because of low interest rates. So this is definitely a good addition or revision that he has. So I know I want to look further into that as well.
Hey, you wanted to talk a little bit about housing and crypto, and I don't really have much to say about that, or at least I don't think I do. So what do you want to touch on those topics?
Well, yeah, just briefly, I thought it made sense if we were looking at the outlook. One thing that stood out to me as interesting is the expectation that mortgage rates are going to go up. And this is all from the data from Realtor.com. But their expectation is that mortgage rates will go up to a whopping 3.4%.
Heavens.
So, yes, that's up. And I definitely, last year you could have got a 30-year mortgage at 2.5. So at 3.4 is a big jump, but historically that's a low number. The other thing I found interesting is and we mentioned this in our real estate outlook episode. You've got this moratorium on foreclosures, right? So how's that going to impact housing? Will there be an opportunity? According to Realtor.com's numbers, they expect home prices to go up 5.7% still, right? So there may be a blip, and it's one source. I've seen a few others. The numbers were different, but the expectation was of an increase in price. And I think with low interest rates where they are, that makes a lot of sense. So from a housing perspective, if you're someone who was waiting because you think prices will come down to buy, that's not what the experts expect with real estate. As they always say, it's all about local, right? It's all about location with the real estate. So you can find a deal anywhere if you're patient and wait, but they're expecting an overall continued increase in housing prices. Eric, you recently did the move.
Yeah.
And you shared with us the story about how it really is a seller's market. Have you seen anything to indicate that that's changed? I know it's only been like really a couple months if you consider when you started the process.
Right. The data that I was looking at were from were ending in October or November, and so it'll be interesting to see in January and February as they update to December, and then in February they update to December, and then maybe in March they update to January. whether or not that's continued. Part of it's a little bit cyclically or seasonally, I should say, seasonally affected. So these tend to be the slower months broadly. So we'll see. But boy, oh boy, from the spike that occurred in June in terms of housing prices in many, not all, but many markets as a result of constrained supply was really it was a dramatic shift from the trend on which those home prices had been rising.
Yeah,
Right,
you
and
hit that for sure, Eric. The supply side of it is also an extremely important element to this, and just the continued competitiveness of searching for homes and closing on them is also just another factor for people to consider.
Yeah, and you mentioned seasonality last year, just because of the timing of the pandemic, that kind of went out the window. You know,
Yeah.
the typical seasonality, but that is likely to come back this year. If you think about last year in March and April, the beginning of that season, there were people who were scared to leave the house, whereas now, you know, with masks on, most people are comfortable. So I think the expectation is that'll come back. And then one last final topic today. It almost lines up with Eric, your comment at the beginning about monetary policy and that potential emerging markets being a currency play. It's just the crypto markets. You know, they've gone up like crazy in 2020, and I have the number in front of me. Give me one moment to pull it up in terms of the increase in the crypto space last year, specifically to Bitcoin. The year-to-date performance of Bitcoin was 218% in 2020. Have both of you been getting more questions about that? It seems to me, it feels like a very frequent topic of conversation now, similar to where it was. What was that? 2000? Was it 18 when it went from like 5,000 to 20,000? Felt like people were asking me about it all the time, and it's similar to that now. Are you getting a lot of questions on that right now, the crypto space?
Yeah, Roshan, you're starting to see it play itself more as a new asset class that's kind of really driving people to look to diversify more. And like you said, the spikes and like the movements it's been making is really starting to catch people's attention. I think that's another area to really look at going forward. What about you, Eric?
Well, I'm not getting a lot of inquiry about it, some, but not much. I think in part there's many other things that are preoccupying people, occupying their attention. And the second part of it, I think, is that there's also this a sense of, if it might have been an opportunity, I've maybe missed that opportunity because it has screened so much higher. And I'm that's mind reading, and I'm not good at it, so I don't know exactly why. I actually have more inquiries about cannabis related stocks than I have about crypto assets. But I would say part in just trying to understand what would lead to that massive rise in valuations of various cryptocurrencies. I think part of it is the fear factor about the health of other currencies, and specifically, reserve currencies like the US dollar.
Yes.
In the Federal Reserve, in response to the COVID crisis, essentially injected trillions and trillions of dollars into the US economy. And as well, the U.S. Congress, and along, with the approval of the president, also did trillions and trillions of deficit spending. So when you look at that, most people would say the logical impact of that surge of newly created dollars injected into the system, while it will undoubtedly have a strong stimulus effect initially, may lead to the weakening in relative terms of the value of those dollars. There's just, and indeed we've seen that thesis confirmed as in the point that I made earlier by how the US dollar declined in value by, as I said, in low double digit decline against a basket of world currencies. So I think it might be, and I don't pretend to fully understand it, but I would say, at least I think it's not a crazy speculation that what's in part driving that is this exceeding fear about the status of other currencies, and people trying to think, okay, how do I put something of my base of wealth in an asset that isn't subject to that kind of manipulation?
Yeah, I can definitely see the arguments for it. The outlook I've seen, what's interesting with this asset class is, and I'm going to speak to Bitcoin specifically just because I have the data in front of me,
Mhm.
is, its high in 2017 was 20,000. It then goes, and in November of 2020, it goes beyond that. So 2017 to 2020, those 3 years, it was just, it declined significantly, and then recovered. Um, but continuing on, then you fast forward, um, just a couple from November, you fast forward just a couple weeks, a couple months, I should say, and it went from 20 to 40,000, and it's now dropped back down a little bit. But uh, I'm bringing up these numbers just to show you that the volatility and the arguments about the price, or where it's going to go, if we're talking about outlook for 2021, I've seen numbers in the neighborhood of as low as dropping back down to 20,000 to as high as 300,000, right? And this is a 2021 number.
Yeah.
So,
Well, the interesting thing about Bitcoin in particular, it seems to me, is that I think this last time that it declined, not the one you just mentioned where it went to 40 and then came down, but was when it was in the neighborhood of 20 and then came down, it came down into the low 3,000s. So that was effectively more than an 80% decline. That was if I'm not mistaken, at least the fourth, if not the fifth time in Bitcoin's history that it had dropped from its most recent peak by more than 80% before it stabilized and then rose again. So I just would say this is an extremely volatile asset class, and I hesitate to even I think of it as, the representations are, well, it's a currency. I would say it's a store of value. That's the weakest possible, in my view. That's the weakest argument in favor of this this asset, because when you think of a store of value, then it doesn't have the relatively stable
stability.
properties
Yes.
that you associate with a store of value. So, but having said that, it's undeniable that it's had these surges. So I would say surges and decline. So I just want to say this is not for the faint of heart, and it's not for everyone. And in fact, I want to say we are not advocating in this conversation, as we're having this conversation, we're not advocating crypto or assets or cryptocurrencies, or let alone Bitcoin. We're just musing about the emergence of this additional sort of new asset class, and just making observations about its behavior.
Yes, and that's where I was actually going into a similar space you are with these outlook numbers.
Mm-hmm.
That, like, I can't think of any other asset that the expectations are, well, it can either drop by 50% this year.
Mm-hmm.
That's one thing that we're seeing.
Mm-hmm.
And on the other extreme, I'm seeing, or it can have almost an 800% return.
Yeah.
Right. I just don't see that kind of a range with anything else we're seeing. So,
Mm-hmm.
but we're, I think, both thinking the same thing. The volatility there is huge. So, do either of you have anything to add on our outlook? We talked about the economy. We talked about the stock markets and sectors, housing, and crypto. Anything to add, gentlemen?
I don't think so. I mean, there's so much we could go on with this for several hours if we wanted to just continue to explore down these various paths that we've pursued. But on balance, I would say my own outlook for 2021, to summarize it all, is that while I recognize there are some people who are warning of a possible recession and a possible market contraction, my expectation is not quite that pessimistic. And that's hard for me to say. I mean, that's unusual for me to say, because I'm often tending toward the pessimistic side. So I would say, I think if we get past COVID, that's the single biggest determinant of what takes place with economic recovery, and also, hence, it seems to me, with market response, as new expectations continue to emerge for the direction of both the domestic and the global economy. That's the I think the primary outlook that I would have. Without completely ruling out the possibility of something that's less positive, I think that's the expectation that I have at this point.
Yeah, I think agree with that, and that's been the case for a little while, right? Until we had the vaccine announcements come out in November, it was stimulus and COVID, right? Those were the two things that were driving things, and we see the stimulus continuing to be added in, and now it's let's get past COVID. So yeah, that looks a lot better than it did just a few months ago, but we still need to get there. Still need to get to the other side. Well, gentlemen, another great episode.
Yes, thank you.
To all of our listeners, thank you very much. This has been another episode of the Retirement Lifestyle Show. We will be back next week with another fresh, fun episode for you. Please like, subscribe, tell your friends, family, give us 5 stars. And thank you again for joining us. We'll see you next week on the Retirement Lifestyle Show.